Welcome to TMS Insights. We've ended August, which is reporting season. So today's purpose, Ben, is to give everybody a bit of an overview of reporting season, but also the back end of some of those reports. Maybe starting with the overview, we'll drill down into some of the results. Again, like about the last 5 reporting season, I think people have had a little bit of concern going into it, but a pretty good set of results overall.
Yeah, I think so. I think if you're calling out one sort of thematic through the month was really good cost control. So we saw margin improvement despite revenues probably not being, for most businesses, not all, not being quite as strong as you'd like to see them. But it didn't, profits generally still beat rather than missed.
Well, there were more beats.
There were more beats.
And expectations are the key thing.
There were some pretty nasty ones in the last week.
Yes.
In the mid-cap space in particular.
Yeah.
Like it definitely feels like smalls and mids on a case-by-case basis, but that was where we saw some clangers.
And the share price reactions, I think you're referring to, there was some down by a quarter and things like that.
Plus,
names we don't hold necessarily. But again, it just shows you the value of meeting market expectations. And again, the difficulty sometimes for certain companies. But we hear about macro pain. It didn't really show up in those results.
No, it didn't.
In some places a bit, but not really.
Yeah, no, I think like the word resilient is it's been so often used over the last couple of years, but it continues to be fairly true. It's, the economy's holding up well. And if you look at a lot of the businesses that we saw, you'd say a broad section, things are going okay. They're not great, but they're holding up pretty well.
So the numbers were overall a bit of a beat. The outlook statement's the other thing we try to hear from companies. How's your business looking right now and for the year ahead and beyond? And probably expectations there might have been pulled back a little bit, I think. So as much as the market's been pleased, it's not overly confident about the year ahead. Expectations for earnings growth, low single-digit sort of percent level, so maybe 2 to 5%.
And I feel like a lot of CEOs are grappling to try and work out where they are in the cycle. It's like there was clearly, when you listen to them present and talk about the outlook, there are a lot of similarities in words used, but challenging was probably the most used word that I heard. And I think everyone is, like a lot of, particularly those big businesses, they're really trying to work out, in this interest rate environment, and what is the rate environment, how does that move? And, there's been a lot of moving parts post the pandemic, and where are we at now? And I think there's a lot of very different opinions on where we're at the moment. Yeah,
that's right. Overall, the market recovered that early sell-off in August, back over 8,000, the ASX 200. That's on a PE of about 17 times, which is a bit above the long-term average. Yeah. So from all of that colouring, what we're now going to drill down to is individual stocks, which is, we ultimately don't invest in the index, it's individual stocks. So let's talk about a few, and quite a few different ones. Yeah. Probably one of the most outstanding ones was WiseTech, which gave some very good guidance by contrast to the group.
Yeah, and again, that was the guidance that the market loved was the margin guidance. Yeah. So the actual revenue guidance that this business gave was identical to what analysts were expecting.
20 to 25% increase. Yeah.
Yes, but a margin of in the early 50% at their EBIT margin, which is phenomenal and well above what analysts were expecting. Yeah. So that means a much bigger profit line that is being anticipated. And I think, this business has continued to deliver on what it said it would. And it's like, there is not a lot of businesses, I can tell you, in what we would call sort of not blue chip, but in the ASX 100 or 200 that are growing at these sort of rates that WiseTech is. But an issue is...
And so it rallied very strongly after that result.
It did. And this sort of, there's been a lot of talk about this in the press, is that there's this real momentum trade at the moment where, investors are chasing a smaller and smaller bunch of businesses that are showing that they can grow, but it's the valuation versus the growth is the tough part.
Bifurcation. The good get bought up extremely heavily, the bad get sold down pretty heavily, right?
Yeah, and that's been a theme for a while now, right?
Sure.
It's there's a break in that when we had the rate hiking cycle.
That's right.
but we're back into that mode again, it feels like.
Let's jump right into the other end to talk about the good and the bad. Mineral resources. It was a disappointing result, and it got some treatment, but it had been, obviously iron ore had been on its way plunging through $100 a tonne throughout the last few months. So that's been an ongoing theme. Lithium's been dreadful. What do you make of that result?
Yeah, you'd sort of say that the resource stocks, where the pain has come from, has been in that area of the markets. It's nearly a third of the Australian market still these days, and I think Min's no different. Chris Ellison's probably a guy that maybe sometimes he says more than he should.
Certainly did, yeah.
And it was one of the more colourful calls that we heard. They always are, but this one in particular.
Well, this is the great line where he didn't want his staff to go out for a coffee.
Yeah. He wants to hold them prisoner.
Missed the fact that he actually provides a gym and childcare centre on site as well. So
and has created an airline that flies his employees around. Yeah. But look, it's he calls a spade, and the reality is that resource companies have gone through an elevated cost environment and commodity prices have fallen through the floor. But I would say with MinRes is that the standout was the mining services and infrastructure division, which actually delivered higher than expectations. It's about a third of their earnings. Yeah. And that's sort of, with all the talk of the lithium disaster and all this sort of thing, it kind of got lost.
But that's a balance of a diversified business, isn't it?
Yeah.
It is diversified.
And it's why we feel comfortable holding it, because the commodity prices, they're going to rebound at some point, and you've got this incredibly high value, much more consistent recurring nature part of the business. And that's where there's real strength in mineral resources.
It's a great segue to the biggest diversified BHP. And again, I thought, Ben, as much as the numbers are interesting strategy, and we've learned about the 5 pillars strategy there for a while, but I'm interested to hear what they said about lithium, which they've said consistently about. They didn't want to be there. But one of the ones on my horizon there is Saskatchewan and the Jansen project.
Yep.
So, that's emerging, I think more half-built now. So that's going to appear in their earnings in the coming years.
Yes.
What do you make of BHP overall?
Well, I think it was a solid result given the environment. Again, it's not an easy environment, but it's still a wildly profitable business, even at iron ore prices that have come off $40 US a tonne. And the copper price has come off as well. There's a lot of uncertainty about what's going on in China at the moment. Copper is now nearly a third of their earnings. Yeah. So I think they've done a good job they were very reliant on iron ore once upon a time. And
they talk copper a lot now, obviously.
And then they've got this potash thing coming on. So that's there's going to be more earnings diversification. And, the CEO's spoken at length about positioning for these future-facing commodities.
Right. And nickel's been their dud, hasn't it, too? So
nickel's been a shocker.
Closed down, written down, all that. So.
Yeah. Look, there's commodities, as we know, they go through cycles, and this is, as Chris Ellison said, it's an awful time to be running a commodity company. You've got to make some very tough decisions.
But there'll be other awful times and other great times. It's a very cyclical business.
Yeah.
A lot less cyclical supermarkets. And I want to pick up on your comment about WiseTech's margins, which people, just to reiterate, Ben was talking about over 50% margin. In the Woolworths result, what I noticed, and we were only just in New Zealand last month, how dire it was there. The Australian business is going well. The margins in the New Zealand business are a bit over 1%.
Yeah.
Imagine that by comparison. So to highlight that. But Woolworths, a reasonable result. Again, totally different business. We're seeing change in management coming through soon.
They've had a bit of a string of some weaker than expected results, and I thought this was actually one of the better ones in recent times.
Yeah.
And Coles, which is another one, has done a very good job, you'd have to say, taking some market share off Woolies, which is probably a bit of a surprise to me, to be honest. But these are still very high quality businesses, generate high return on equity. The valuations look pretty good.
Yep.
For what is a bit more of an expensive market at the moment. And I think Woolies, it's a good sleep at night stock.
Let's talk infrastructure, which should be a sleep at night sector overall. And we see it actually has been an underperformer, the listed space, over the last few years. But we really think it's a great asset class for long-term savings, superannuation, etc.
So and funding and a lifestyle as well.
It's a totally commensurate and long duration sorts of assets. So let's talk APA, which was sold down. Auckland Airport, which again is post-COVID, its recovery is strong, but its share price isn't. And Cuba Logistics, which has done really well.
Yeah. Look, I guess the commonality is these businesses in a higher interest rate environment, it's tough on the share prices. And I think if you looked at all three results, you'd all growing earnings, growing distributions to shareholders, but the biggest headwind has been rates going from 0 to 4.35. And, I think you can forget that these were awesome stocks to own in a different period when rates were in longer term decline, and they could become that once again. So I'd say, great assets, gearing levels are under control. Transurban's another one. They've all underperformed in a tougher rate environment, but we are potentially getting closer to a tipping point, and the share prices will start to move. We've seen the New Zealand Central Bank has cut rates out of nowhere, and are now well and truly in a rate cutting cycle. So well worth a place in a portfolio and still paying very good distribution yields.
Very good. One of our biggest and best loved companies is Westfarm. As they reported, they've had a stunning year, really, share price wise. And Kmart being a real hero of theirs. Bunnings still very good. Obviously, lithium not a big contributor there. But what do you make of their result, Ben?
Yeah, it's surprised everyone how well Kmart's going, and they've got this brand called Anko, which is they're now actually selling into Target in the United States. It's becoming a beast in its own in a good performing space. So, if you listen to Rob Scott present, everyone is looking for value. Wesfarmers plays well into that theme, whether it's through Bunnings, Officeworks, or Kmart. The lithium mines, which have ironically come online into a very
soft
weak
market,
environment. At some point, they'll start spitting out cash. And this is the thing we love about this model is, there's optionality in different parts of it. Not all parts run at the same time.
And Kmart's the biggest example. It had been a dud for a decade, basically.
Yep.
And it's been the big engine.
It's the winner at the moment. Yeah.
As we say, people don't like to admit that they shop there, but they do. It's done very well. Maybe an update too on one of our stocks we mentioned last time, real estate, REA Group, which had announced yesterday a potential bid for Rightmove in the UK, which is obviously similar to them in terms of the way they operate a property portal, but every jurisdiction is different, Ben. It could be a $9 to $10 billion sort of play, so it's material.
Yeah.
What can we make of that?
Well, I think everyone's in a bit of two minds. We've seen a lot of businesses go into US and UK and blow a lot of cash ultimately. There hasn't been a lot of success stories. But Owen Wilson, I would back as one of the CEOs you would say has got a great chance of pulling something like this off. If you look at Rightmove, it trades on about
lower multiples,
50% lower multiple.
High ROE.
And also a pricing model that looks exactly like REA 10 years ago. And that's where I think a lot of the upside is. In the UK, if you put your house up for sale, they're still on a model where the agency pays a fee to REA and then there's a flat fee that they'll pay on top of that. Now, we some time ago went to a user pay system where we would, and I'm sure that they look at that and think that they could flex a lot of profit out of this business, which is the dominant
proven here.
way.
They've done that here. So
completely
it's rolling out the same theme book. And
so not without risk, but a lot of reward if they get it right.
And obviously the market sold it down, and that's based on long-term history, like you said, of Australian companies not getting it right. And we actually just talked about Wesfarmers who have that incredible business, Bunnings, that they couldn't translate to the UK. So naturally people are a little sceptical. So see how it plays out. They've got to resolve this by the end of September under UK takeover laws. So it will be one in play the whole month and probably for some time beyond that.
Let's see how it goes. But I think if there's one business that can pull this off, and you can really see a lot of logic behind the acquisition, for me it would be REA, but...
And the stock could also win if they don't proceed with it.
Yeah.
Because it was $20 higher before.
Yep, completely.
So
we'll see. Yeah.
Good one. All right. Well, that's all we've got time to. A good reporting season to wrap you up today, and we'll look forward to bringing you another insights later in September.